battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are the Stenger Family Office. For the past 44 years, Stenger Family has made it our mission to deliver you clarity and confidence to help secure your financial future. It's episode 190. I called it The Fed Should Cut. I do think they should cut. We're going to talk about it in 1 second, and I want to show you some slides as well. But somebody on the YouTube channel, by the way, we just hit 500 subscribers. Thank you so much. If you subscribed, if you haven't yet, do that as well. But thank you. It's been a wild ride to get here the past couple months, but here we are. Somebody on YouTube the other day accused me in the comments of wanting the Fed to run the printing presses, and that could not be further from the truth. So don't hear this episode as Nick is a big-time stimulus proponent. I'm actually not. In fact, if you go back and watch all the episodes that we've done, remember, we're on 190 now. I've talked about the Fed on probably half, maybe 60% of these shows, saying I don't think the Fed should just run the printing press. I don't think we should run these massive deficits and everything should be based on central planning. I've said the exact opposite of that. I want a smaller Fed, a smaller government in general, and reasonable laws and taxes and all the rest of it. So this episode may come across as, oh, Nick just wants stimulus and the Fed to run the printing press. That's the exact opposite of what I'm saying. But I will tell you, I do think the Fed is a little bit high. Remember, the Fed operates always on a lag. And so when we were going through COVID, we printed 40% more dollars in the economy. Fed said that the inflation that we had at the time and then going into 2021 was transitory. That was the big word they used all the time, was this was transitory. And so all the inflation was due to supply chain. And when the supply chains got fixed, everything would go back to normal. And we said the exact opposite. It wasn't just us. We were talking with First Trust Portfolios, talking with Wisdom Tree, with Dr. Jeremy Siegel, who actually came on the podcast and talked about this with us. And they were saying the exact same thing, that inflation is always and everywhere a monetary phenomenon. That's Milton Friedman. And so it's not rocket science to figure out, okay, now we have some of this inflation. On the backside of it, I think some of the bearish people have been wrong because they look at the Fed's balance sheet shrinking. They look at the rate of M2 increasing or decreasing in the economy. And I think a lot of people said, well, if M2 decreases, we're going to have this massive recession. And that's probably true at some point, but it just hasn't happened. If you look at the velocity of M2, it's slowed, but M2 is still at almost record all-time highs, even as the Fed has continued to shrink its balance sheet. I think instead what could happen is if you end up with a labor market problem, which I'm going to show you in a second, if we end up with a labor market problem longer term, that's where the Fed's going to be late to the game. So that's why I say the Fed is operating on this lag. They raise rates at the fastest pace they ever have. If you throw this chart up, Producer O, Fed rates are the highest since 2008. Yes, we've come off the all-time high. We've had a couple of little cuts, some relief, but we're still at higher levels than I think we should be. And even the Fed themselves has said, okay, we're tracking in unemployment, we're tracking the labor market. But if you look at that stair step up and down, they always are forced to raise very, very slowly, and then they have to go down the other side like an elevator. Why? Because they're reacting to negative news. And by the time they react to that negative news, it's already priced into the market. So that's why you cannot time these things out. Now, let's go over to our next chart. Here's reason number one, why I think the Fed is probably a little bit too high. Energy prices now are starting to get into the zone. They're not quite at the 2020 levels, but they're in the zone with the 2019 levels. This is crude oil prices, West Texas Intermediate, and WTI. And crude oil prices are one of the most important drivers of economic growth and inflation. It's such an important factor. It goes into shipping costs, it goes into freight, goes into all the different goods that we have as end users. And if you get energy prices down like we have now, I believe, even with the conflict in the Middle East, I think with the fracking that we have, all the supply we have, now with a president who wants to unleash American energy independence, which, by the way, is not a left versus right issue. It was unleashed under President Obama previously. It was President Obama's EPA that declared that fracking was okay, and it was continued under the 8 years that Obama was in office, and then under Trump now. And so I think with energy prices coming down, we're going to be in really good shape. there's going to be less pressure on inflation. Let's go to number two. This is my second reason why I think inflation isn't as bad as the Fed thinks now. And this is home prices. Home prices not back down to 2020 levels. You're not going to see them go back down to 2020 levels because, yes, there's still M2 money supply in the system. So when you increase the supply of money, we all start out at the beginning of COVID with 100 grand. You print 30%, 40% more dollars. Let's say now we all have 140 grand. Anybody with assets doesn't actually really have any more increased buying power because, again, if you move right now, you're going to sell your house at a profit, but you're going to go into the next house and that person's selling their house to you at a profit. So it's a break even. You're going to see some moderating here in home prices from the record all-time highs, but home prices are not rising up and going up to the right like they were during COVID. So I think, if you look at the home builders here, Lennar is way down. A lot of these home builder stocks are down. Sherwin-Williams, Home Depot, pricing in, I think, some pressure that home builders are seeing right now. I think ultimately it's not going to turn into this major problem. And I think we are going to have a recovery in these home builder stocks. But if you look at the home prices, we're getting back to a more normalized level of where a house should be. Okay, number three, next slide, consumer inflation now is only up 2.4% year over year. And I say only because the Fed's target for inflation was 2%. Now, you might say, well, Nick, that means the Fed rate hikes are working, and shouldn't Powell now just keep rates where they are and get the inflation back down to 2? Well, I think the risk is you're starting to see a little bit of weakness here in the labor markets that you didn't see last year. So remember, the Fed likes that JOLTS report, job opening, labor turnover summary that comes out, and they like to watch not just two declining quarters of real GDP that would signal a recession, but also pair that with the labor market. So this is my next slide for you, the Fed's biggest nightmare, which could be the employment market. This is job openings. We peaked way up right after COVID at 12 million unfilled jobs. Now we're back sub 8 million, which again is not bad. That's where we were during 2018, 2019, 2020. So all this to say, I don't think we're going into this all-out collapse. I do not think we're going to go out into an abyss of a recession, an 08, 09, 2020 style recession. Rather, we're just getting back to a more normalized level of economic activity. And that's what you're seeing in the employment market. Now, here's the other side of employment. We just talked about job openings. Let's talk about the other side, which is the unemployment rate. Right now, unemployment's in that 4.2% range. And again, it's not spiking way up. You're not seeing this massive spike back to 10% or 8% or wherever economists think that a recession would come into play, probably around 8 to 10%. You're not anywhere close to that. But you are seeing that trend line go back up. And when you see the trend line of unemployment start to rise just a bit, all of a sudden it can turn into a spike if the Fed's not careful. And so I think when you look at all these data points, when you add up the Fed where they're at today with a 2% mandate, and also with inflation only coming in at 2.4% year over year, with the labor market maybe not weakening a ton, but normalizing for sure, I think the Fed right now is about 0.5% too high on interest rates. And if you look at the spreads on mortgages have blown way past where they should be. Some people have gotten locked into 7% mortgages that really should be priced at 6.2, 6.3%. And it doesn't sound like a major difference. But when you're a middle-class family and you get a 1% relief or a 0.5% relief on your mortgage, it's a major, major win for the economy. And so, again, I say there's these two levels of the economy that you're seeing right now. You're seeing the economy where more people have gone on food stamps than ever before this year, but at the same time, more people are taking a European vacation than ever before. So if you want to restore the middle class, if you want to get the middle of the country back, upper middle class back, you've got to give them some relief on inflation, because on interest rates. Because if you don't, you're going to continue to see wealthy people that have cash that don't have to finance. They're going to go out and pay cash for everything, just like always before. The lower class is really going to struggle, but the middle class is going to get crushed just like always. So what's the bad side of a big government, of a big Fed? It always, always, always crushes the middle and lower class. And so if you want more prosperity in those zones of the economy, you have got to get less central planning, more entrepreneurial-led capitalism, more innovation, more ideas that ultimately bring down costs. Now, the saving grace of all of this, and despite what the Fed does, they're going to meet today, and then you're going to hear from Powell this afternoon. Despite what the Fed does, the silver lining here And what's always been the silver lining of the economy has been the entrepreneur and technology. And technology has never moved as quickly as it does today. It's just absolutely astounding when you look at all the different innovations that are coming out with the cloud and machine learning and AI and robotics and quantum computing, and it's just incredible. So if you aren't aware of what's happening, I would encourage you to go get a science journal, go get a technology journal, subscribe to some of these people that cover technology, because it's just fascinating. And that's what's going to ultimately power the economy forward and bring down costs and also reduce inflation in the long run, no matter what the Fed does in the short term. So yes, I do think the Fed's a little high, but I think eventually later this year, you probably are going to get a cut, and that's going to be a positive thing for the stock market. Now, where does the stock market end up? I think long run S&P is worth 7,000 points. I know it's crazy to say that here today at 6,000, but it sounded even worse when the S&P was at 5,000. We bounced right off that 5,000 low. We're back to 6,000 today. And I think with the earnings trajectory that we're seeing on some of the value stocks, industrial stocks, energy companies, a variety of financials that are doing very well right now, I think you're going to see S&P profits push up to $350. You're going to multiply that by 20. And eventually, maybe it's not this year, maybe it's late next year, who knows? Don't have a crystal ball to tell us for sure, but I think we will hit 7,000. So stay bullish, stay optimistic. Now, before I let you go, we've got two very important events that you absolutely should be on. We've got episode 200 of the show coming up very soon. We're only 10 episodes away now from episode 200. Thank you so much for all of you who have been on since the very beginning. I know who you are. I just can't tell you how appreciative we are of our folks who have been with us literally since day one, who haven't missed an episode. So this event is especially for you, to thank you for being with us since the very beginning. And that's going to be August 26th. Let me go over to my next slide here. And this is August 26th, episode 200 live. This is going to be downtown Naperville. And if you want to attend this, you got to email or call Katie the Greek, Katie Poulos, 630-923-7883, katie.poulos@stengerfamilyoffice.com. And last but certainly not least, we have Investor Day coming up October 16th and 17th in Oak Brook. Do not miss this thing. It is basically at the point where I think we've got almost 40 people signed up. We've got room for 135. We haven't sent out the email blast yet. The mailer just went out. I told you this thing fills up super, super quickly. So if you want to come to Investor Day, this is going to be probably one of your last few chances. We're going to have a few more reminders about it on the show. We're going to have an email go out, but make sure you register. You can scan the QR code there if you're watching on your computer. You can also call Katie again or email her, katie.poulos@stengerfamilyoffice.com. Thank you so much for being here. We're going to see you next episode, episode 191.